Welcome to this revision video on Ind AS 7 Statement of Cash Flows. So, what are cash flow statements? Cash flow statements are basically a presentation of cash, bank and cash equivalents. What are cash equivalents? They are short-term, highly liquid instruments with insignificant risks of changes in value. So, the standard defines short-term as those instruments which have a maturity of less than say 3 months from the date of acquisition. Please note that this 3-month period is only indicative, it is not a strict rule. The principle is that the purpose of holding that investment should be to temporarily park your surplus cash. There should be no risk of changes in value, it should be highly liquid. So, whenever you want, you should be able to liquidate it without any changes in their value, right. So, this 3-month period also, the indicative period, is defined as the period from the date of acquisition, not from the date of issue. So, suppose on 1/4/2024, a company X Limited has issued 8% debentures, right. So, we being the entity, we are acquiring these debentures on say 1st February 2026. Entity buys 8% debentures. 31/3/2026 is its year ending and 1/4/2026 is the maturity of the debentures which were issued on 1/4/2024. So, it is a 2-year debenture. Now, the question is it classified as short term? So, do we need to check the period from the date of issue till the date of maturity or date of acquisition till date of maturity? So, the standard says it should be from date of acquisition to date of maturity, and if this is a short term, say less than 3 months, then it is classified as a cash equivalent subject to the other conditions being fulfilled. So, cash equivalent should be short term, highly liquid with insignificant risk of changes in value. Bank overdrafts may be considered as cash equivalents if they are part of the cash management operations of the entity. Cash flows are classified into operating, investing and financing. Movements between the components of cash and cash equivalents are not cash flows. So, operating are those which are principal revenue producing activities. So, this varies from business to business. So, for a real estate company, purchase and sale of land may actually be operating. That may not be the case for other entities. So, depending on the nature of the business, this has to be identified. Investing, resources intended to generate future income and cash flow. So, you buy an item of property, plant, equipment that generates future income by way of helping you produce your product. Financing relating to providers of capital. What are the methods of presentation of cash flow statements? So, there are two methods, direct and indirect. In direct method, essentially whatever is there in the cash bank account, it appears as it is in the cash flow statement under different heads, operating, investing and financing. So, all the cash flows are presented directly as they appear. In indirect method, certain cash flows are presented indirectly. Which are they? Operating cash flows excluding tax. So, tax is always presented directly even in indirect method. We show tax paid or refund received. Investing and financing are always shown directly even under indirect method. So, the difference between direct and indirect method only relates to the operating cash flows before tax. Only these cash flows are presented indirectly. So, we can say that cash flows that are always presented directly or investing and financing activities and tax flows, whichever method is followed, whether direct or indirect. And the cash flows that are presented either directly or indirectly, depending on the method, are the operating cash flows other than tax. So now let's see how to prepare cash flow statements under each method. Direct method, which is what is encouraged by Ind AS 7, we prepare from the accounting records. So what this means is, you see what is the cash paid to suppliers, cash received from customers. You extract the individual line items that you are going to use in the cash flow statement directly from the accounting records, right? So that is how we normally do. The other method that is permitted by para 19b is by taking the operating income and expenses individually. You start with sales. So you adjust the movement in balances of debtors, bills receivable, and you arrive at cash received from your customers. So individually, line by line, whatever you are going to present in the cash flow statement, you make certain adjustments for the working capital changes as well as the non-cash items, non-operating items, you arrive at the cash flow. That is also permitted. So essentially, in the exam, if they don't give you the line items, what do? We prepare debtor account, creditor account, we identify what is received from debtor, paid to creditor, or we prepare working notes. So that can also be done in the cash flow statement. Okay, that is permitted by para 19b. Next is the indirect method. So the first alternative is what we normally do. We take the total profit or loss, we adjust it for working capital changes, non-cash, non-operating items, and we arrive at the cash generated from operations. The other method that is permitted by para 20 is, you take the relevant revenue and expense line items from the statement of P&L and you make adjustment for changes, inventory, operating receivables, payables, and so on. Essentially, you pick and choose. From the P&L, you take only those revenues and expenses which are operating, and then you make the necessary adjustments. So this is also permitted. Next, when can cash flows be reported on a net basis? Two conditions need to be satisfied. So the cash receipts and payments are on behalf of customers and they represent activities of the customer rather than those of the entity. Some examples are given in the standard itself. So cash receipts and payments on behalf of customers. Some examples are acceptance and repayment of demand deposits of a bank, funds held for customers by an investment entity. So let's say an asset management company. Then rents collected on behalf of and paid over to the owners of properties. You are acting as an agent. Then for 22B, that is when the turnover is quick, amounts are large and maturities are short. So some examples are principal amounts relating to credit card customer. These can also be shown on net basis because it keeps getting paid, right? Purchase and sale of investments can be shown on net basis provided turnover is quick. So mainly it's an investment company. And short term borrowings which have maturity of 3 months or less, they can also be shown on net basis. So basically two types of items for which net basis reporting is allowed in cash flow statements. So it is on behalf of customers and they represent activities of the customer. Second, when turnover is quick, amounts are large and maturities are short. So next we come to foreign currency cash flows. So we know how to report foreign currency cash flows. So we've seen that in Ind AS 21. The specific adjustment required has been explained in a separate video. You can refer that video, it's given in the description below. So basically in that video we saw that even for cash and cash equivalents, generally no adjustment is made, but foreign currency gain or loss relating to cash and cash equivalents must be shown after the cash flow statement in order to reconcile the cash and cash equivalents as per the cash flow statement with the values as per the balance sheet. So, the logic has been explained in that separate video. You may please refer that. It is there in the link below. Next is interest and dividend. So, Ind AS 7 clearly specifies how to classify interest and dividend. So, for financial institutions, only dividend paid will be financing, everything else will be operating. Interest paid, interest received, dividend received, they are all operating. For other entities, paid is financing, received is investing. Interest paid, dividend paid is financing. Interest received, dividend received is investing. Now, there are arguments to treat interest as operating also, even for other entities. But Ind AS 7 clearly specifies that interest paid has to be financing, dividend paid also has to be financing. Interest received and dividend received will be investing. So, this mandatory classification is from the words should be classified, that is there in para 31. Now, in the standard, in paras 33 and 34, the other arguments are given, but what is to be done is in para 31. They should be classified, right? How should they be classified? That is clearly given. That is what we saw on the table. Further, in appendix 1 of Ind AS 7, there also it is clearly mentioned that IAS 7 gives the option, but in Ind AS does not provide such an option, right, both for interest as well as dividend. So, these lines in the standard make it very clear that it is a mandatory classification. So, for financial institutions, except dividend paid, because dividend is paid to the owners, it is a source of finance, that is financing, everything else is operating. For other entities, paid is financing, received is investing. Now, what if you have paid interest on a qualifying asset and that interest is capitalized as per Ind AS 23? That interest paid will be shown as investing only, okay, because it is capitalized. Ind AS 23 here overrides, fine. So, interest capitalized as per Ind AS 23 should be shown separately under investing activities. Next is the treatment of taxes on income. By default, they are shown under operating activities, but if they can be specifically identified, they may be shown as financing, for example, dividend distribution tax, or under investing activities, for example, capital gains tax. So, next we are going to see how to present cash flows that relate to changes in ownership interests. So, what do we mean by this changes in ownership interest? So, let us say you are acquiring controlling stake in a company, say you are buying 60% of the shares of that company, you are gaining the ownership interest, right. So, where should that come? That should be classified as investing activities, right, that is an investment that you have made. Say from 60% it comes down to 0. You are giving up that control. So, you have held controlling stake for say a few years, you decide to dispose of the investment. So, you lose controlling interest, that is also investing activity. So, aggregate cash flows from obtaining or losing control should be shown as investing activities. Another point is they should not be netted off, okay, should not present net. So, let us say in a particular year you have gained controlling interest in subsidiary A and you have disposed of controlling interest in subsidiary B, both should not be netted off, right. Coming back to the previous example, so from 60 you bring it up to 80, you already have control, you are just increasing your shareholding, or from 60 you bring it down to 58, you are not losing control. Where should you show this? So, standard says these should be shown as financing activities because they are just equity transactions, right. So, cash flows that do not result in loss of control. So, the standard gives this category, do not result in loss of control. That does not use the word do not result in gaining control, because the presumption is you already have control. That's why it's phrased this way. So you just need to remember that purchasing or selling of shares by a parent of a subsidiary, that does not result in loss of control. They are equity transactions, therefore they are presented as financing activities. Now there is an exception, and that is subsidiaries that are held by an investment entity that measures investments at fair value through P&L. So as per Ind AS 110, investment entities do not consolidate the subsidiaries, but they instead measure them at fair value through P&L. Of course, there is one exception given in Ind AS 110, that is if that subsidiary of that investment entity is providing investment related services, right? It is helping the investment entity in its business. So that should be consolidated, but in other subsidiaries. So there is a company I Limited, it gains controlling interest in a subsidiary, let's say S Limited, totally different business, nothing to do with the investment entity. So how should it consolidate? It will not consolidate. It will just show that investment at fair value through P&L. That is the rule given by Ind AS 110. So because of this rule, for an investment entity, all cash flows. So an investment entity purchases 60% shares. That is anyway investing activity. Sell 60% shares, losing control. That is also investing. Even for other entities also it will be investing. But from 60 it makes it 80. That is not treated as a financing for an investment entity. That will also be investing only. So all cash flows, either gaining control, losing control, or otherwise, they are all treated as investing activities only. Okay. So there is an option for dividend received, because why would an investment entity buy controlling shares in a company? So obviously it wants to control that business, and it's mainly interested in the income from that business. So dividend is the principal revenue producing activity for an investment entity. So by that logic, dividend received from such subsidiaries may be classified as operating. But the simple rule is, for investment entities, everything is treated as investing activity, right? For other entities, there is a distinction made. If it results in gaining or losing control, it is investing, otherwise it is financing. But for investment entities that measure its investment at fair value through P&L, everything will be investing activities only. Optionally, dividend received can be operating. So another important point is the presentation of the consideration that is paid or received when obtaining or losing control. The standard says, for obtaining control, the consideration paid should be shown net of the cash and cash equivalents of the subsidiary recognized. Same way for losing control, the entry is going to be reverse. Consideration received should be shown net of the cash and cash equivalents of the subsidiary derecognized. So essentially, all the net assets of the subsidiary that are acquired are being shown under investing activity. So we are showing net assets of the subsidiary acquired, and what amount we are going to show? B minus A. So essentially all these assets and these liabilities are being shown as investing activity, right? So when you prepare the cash flow statement in operating activities under indirect method, we need to adjust working capital items. So when you adjust working capital, this portion of that working capital is already shown in investing. This will apply only in the year of obtaining control or losing control, right? So appropriate adjustments have to be made, and a sample is given. So in that previous entry, we had inventory, debtor, creditor. These were the working capital items. we have opening balance plus acquired from the subsidiary and then closing balance. The balance will represent change other than due to acquisition. That will appear in working capital changes when cash flow statement is being prepared under indirect method, right? Next, there are some disclosure provisions. Changes in liabilities arising from financing activities. So, cash flows that are now financing activities or the future cash flows will be classified as financing activities, and if there are any liabilities relating to that, then these disclosures should be made. So, what are the disclosures? The changes in the liability from financing cash flows, for example, payment of dividend. Then changes arising from obtaining or losing control of subsidiaries or other businesses. Changes in foreign exchange rates, changes in fair values and other changes. So, basically importance is given to those liabilities which relate to financing activities. This applies also to financial assets. So, one way to give the disclosures is to give a reconciliation between opening and closing balances of those liabilities, and they should be reconciled with the balances in the balance sheet and as well as in the statement of cash flows. Next, disclosures relate to components of cash and cash equivalents. So, what policy it is following to determine what is the composition of cash and cash equivalents, that has to be disclosed. Further, a reconciliation has to be given between the balances appearing in the cash flow as well as in the balance sheet, and this reconciliation we give especially when there are forex changes relating to cash and cash equivalents. And if you change the policy, so suppose bank overdraft is part of your cash equivalents and you change this year onwards, you are excluding bank overdraft from cash equivalents, then it is to be accounted for in accordance with Ind AS 8. That means retrospective restatement has to be done. And there are some other mandatory disclosures. So, if there are any cash and cash equivalents of subsidiaries that are not available for use by the group, for example, the subsidiary may be a foreign country and there may be some foreign exchange restrictions. There may be some restrictions on utilizing the cash and cash equivalents, then that has to be disclosed. Then these are all recommended disclosures that are given in para 50. So, if there are any unutilized limits, so let us say you have borrowing limit of 1 crore and you have utilized say 60 lakhs. So, 40 lakhs is undrawn borrowing facility that may be available for future operating activities and to settle commitments. This is encouraged. Then the cash flows that increase the operating capacity separately from maintaining operating capacity. So, the outflows that are helping you to increase your revenue generating capacity. Let us say you have purchased machinery to add to your capacity, to add to your production lines. That should be separately disclosed from say significant repairs on machinery to help you maintain the existing level of operation. So, this has to be disclosed separately. They are not talking about classification here. Whatever cash flows represent increase in operating capacity. It does not mean operating cash flow. That cash flow may be an investing cash flow, but if that is increasing the operating capacity, you give a disclosure. Or if there are other cash flows that are just maintaining operating capacity, that also you disclose. For example, even replacement of a machine without increase in operating capacity, that also will come here, right? Then segment wise information. So, operating, investing and financing activities of each reportable segment, that is also encouraged. And then difference between IAS 7 and Ind AS 7. So, IAS 7 gives the option to classify interest paid, interest and dividend received as operating. That option is not available. IAS 7 also gives the option to classify dividend paid as operating. That is here classified as financing only. So, let us now go through the format of the cash flow statement when it is prepared using the direct method. This is just an outline. So, as you all know, it is divided into three parts: cash flow from operating activities, investing and financing. Under operating, we write the line items just as they would appear in the cash and bank account: received from customers, paid to suppliers, and so on. And then we get a subtotal before tax, and then tax received, refund received or tax paid. We get net cash from or net cash used in operating activities. Then cash flow from investing activities, we just list out the various items. We may get capital gains tax if any here, that also has to be shown separately. And then net cash from or net cash used in investing activities. Next we have cash flow from financing activities. So, this also we just list out the various items: net cash from or used in financing. You may get dividend distribution tax if any as a separate line item. So, this investing and financing activities, the manner of preparation is same in both methods, direct and indirect. Then we get net increase or decrease in cash and cash equivalents, then cash and cash equivalents at the beginning and at the end. Now, even in direct method, we need to adjust forex gain or forex loss, because this cash and cash equivalents at the end will be before forex gain or loss. And when we say forex gain or loss, we are talking of only that portion that relates to cash equivalents. So, why we need this is because in direct method, all cash flows, operating, investing, financing, we pick the individual line items from the cash and bank account. So, forex gain or loss we would not have written anywhere, because that is not a cash flow. But unless you write this, so when you are taking cash equivalent on which there is a forex gain or loss, if you do not adjust that, then the balance as per the balance sheet will not tally. So, this is more of a reconciliation. The cash flow statement actually ends here, cash and cash equivalents at the end of the period. Then we adjust forex gain or loss, and then we get cash and cash equivalents at the end as per balance sheet. So, there is a separate YouTube video on forex adjustment. You may please go through that video. So, next let us go through the format of the indirect method. Again, this is an outline. So, cash flow from operating activities, this is where the change happens. So, we start with profit. Now, we can start with different profit values. So, we may start with profit as per the balance sheet. It is difference between closing and opening balance of the P&L. If we do that, then we have to make adjustments for appropriations also, because essentially what we are trying to do is we are trying to arrive at only that profit that relates to the working capital items, excluding cash and cash equivalents. So, the reason we are writing profit here is to arrive at the cash flows relating to debtors, creditors and so on indirectly. So, we need only those P&L items relating to those ledger accounts. So, other expenses and incomes we want to remove. Now, for a detailed explanation of this logic, there is a separate video on YouTube. The link is there in the description to this video. You may go through the same. So, we will just summarize the adjustments. So, we make adjustments for the appropriations, we add the debits, subtract the credits, then we get profit after tax. So, if you start with profit after tax, you do not have to make any of these adjustments. So, if you start with profit after tax, you need to adjust tax. So, plus the tax debit and minus the tax credit, you get profit before tax. So, it follows that if you start with profit before tax, or if this is given in the question, then you do not have to make any of these adjustments. So, when you start with profit before tax, you need to make P&L adjustments. So, the P&L adjustments to be made along with the logic of why they are to be made is explained in a separate YouTube video. You can go through that video. So, to summarize, we remove non-operating expenses by adding non-operating incomes by subtracting, and we make adjustments for forex loss and gain also. we don't make any adjustments for forex gain and loss relating to the working capital items, but relating to all other items, cash equivalents, investing and financing. Then we make adjustments for working capital changes, we get cash generated from operations. And then after this, it is the same as the direct method. So we add tax refund, subtract tax paid, we get net cash from or used in operating activities, and then we get cash flow from investing activities, financing activities, net increase or decrease, and then here again we adjust forex gain or loss because this is the reconciling item. So this logic also is explained in that separate YouTube video. You may please go through. Well, let's do some illustrations from the study material. Illustration 1. This is about which items will form part of cash equivalents. So cash equivalents, as we all know, short term, highly liquid instruments readily convertible to known amounts of cash, subject to insignificant risk of changes in value, and when we say short period, generally 3 months or less. From which date? From the date of acquisition, not date of issue. So they have given fixed deposit with SBI 12%, 3 years maturity. So from date of issue it is 3 years. That's not a short period. This is not cash equivalent. Same way fixed deposit with HDFC, original term 2 years. So when you talk of fixed deposit, obviously it is unique to that particular company. So when it says original term, it means it has acquired the fixed deposits with a maturity of 2 years. Due date is not relevant. So original term is more than 3 months. It's not cash equivalent. Redeemable preference shares acquired on 31st Jan, redemption due on 30th April. So within 3 months. So this can be part of cash equivalents. Cash balances at various banks, whether in India, outside India or foreign banks, they are all cash equivalents. Bank overdraft, it forms part of the cash management, then yes. Treasury bill 90 days maturity, that also yes, part of cash equivalents. Next, let's come to illustration 5. So here entity has entered into a factoring arrangement, received money from the factor. Examine the said transaction and how it should be presented. So factoring can be with recourse or without recourse. So if it is with recourse, so suppose you are the entity and I am the factor. You have your debtor. So basically what you are doing is you are asking me to collect money from your debtor. I give you an advance. Generally factoring involves an advance payment. So today I give you that advance after deducting my commission and all that, and on the due date I will collect from your debtor. So suppose the debtor doesn't pay me. If it is with recourse, then I can come back to you. I pass on that credit default risk to you. If it is without recourse, then I have to bear the loss. So if it is with recourse, that is if I can come back to you, then you are still bearing the risk, right? So essentially it is just a financing arrangement. So I am giving you the money now. On maturity you have to pay me back. Either the debtor pays me back, or if he doesn't pay, you pay me back. So from your point of view, you are just receiving money in advance from me. So that is financing. But if it is without recourse, that is if the debtor doesn't pay me and I cannot come back to you, that means essentially you are selling that asset to me, right? So then when you sell, when you basically liquidate, you are realizing the value of the receivable, then it's operating. It's like receiving money from the debtor, right? So if it is with recourse, then the treatment is financing. If it is without recourse, it is operating. Another point regarding with recourse is, till the money is realized from the debtor, you will have to show both the receivable and the payable to me. So only when the debtor pays me, you can derecognize both the liability and the asset. So that derecognition is not a cash. So today when you receive the money from me, that's what we are talking about. So in recourse it is, with recourse it is financing. and if it is without recourse, it is operating. If it is without recourse, the both are immediately derecognized. So basically you pass the entry cash to debtor, right? So you are derecognizing the debtor. So you are receiving cash from me, the factor. You don't have any liability to me if it is non-recourse, because I cannot come back to you. Essentially you are going to pass the entry cash to debtor, right? Whatever commission, that expense will be recognized. So cash expense to debtor. So there is no question of later derecognition, immediately itself it is derecognized. Next, let's come to illustration 7. This is a deep discount bond. So the interest is not paid during the term of the bond. The bond is issued at a discount and it is redeemed at face value. So effective interest rate is given in the question, 15%. Face value 10 lakh and amount paid is 5 lakh. This is a 5-year bond. So during the 5 years, interest income of course will be recognized, but there is no cash flow. Cash flow arises only at the end of the 5th year. So at that time you will receive 10 lakhs, out of which the cumulative interest is 5 lakhs and balance will be principal, right? So that principal component and interest component are basically bifurcated in the last year. So on the last year, whatever is the principal amount, balance outstanding, that will be of course both are going to be shown in investing activities, but you just show interest and principal separately. Interest for the year, interest for the remaining previous 4 years, and also the principal amount of 5 lakhs. Next, illustration 8. So here there is advance tax, of which 30,000 is for long term capital gain. So that portion should come where? Investing. Balance will come in operating. Now let's just briefly go through illustration 11. This is a simple question. It's just an example of what you need to do in the exam. So you are given a balance sheet and you are given you have an equity, you have other equity. So it has increased from 8 to 12, 4,000. When you come down, profit after tax is given in the question. So if you take profit after tax, you don't need to adjust appropriations. So but it's good to just check. So in the balance sheet, the increase is 4,000. They say profit after tax is 4450. Interim dividend is 450. So the net increase, if you get here 4450 minus 450, that is 4,000. So that gives you confidence that everything that's there in the movement in the balance sheet, that is from 8 to 12, is accounted for. Otherwise, there may be some hidden items which you may have to adjust, right? So the rest is all just usual adjustments. Let's now go down to illustration 12. This is an example of an illustration where rectification adjustments need to be passed before attempting the cash flow statement. So for example, they have given that renovation is charged to P&L. So it needs to be adjusted to the profit before tax. It needs to be added. And then construction cost that has been charged to expense instead of capitalizing. Same way interest cost. So these adjustments need to be made before you complete the cash flow. Another example, another adjustment that's there in this question is the associate information. Now the share of profit of the associate that is recognized, that's not a cash flow. So that will not come in the cash flow statement. So here in the they have given share of profit of associate, so that also has to be removed. Let's now come to the test your knowledge questions. Question number 3. So here the forex adjustment relating to cash equivalent has to be done. So there is some money in a foreign bank. So $1 lakh, 31/12/2011 and 31/12/2012, it was $1 lakh and $1 lakh $2,000. The balance has increased by $2,000, and this is calendar year. So opening and closing exchange rates are given, 45 and 50. So increase in balance was on account of interest credited. So the deposit amount has not, there is no change actually, it's only because of interest. So that $1 lakh from 45 opening, that will be reported at 50 closing. So 1 lakh into 5 rupees, that is 5 lakh rupees is a forex gain relating to the cash and cash equivalents. So how will this be presented? So obviously interest received will be shown at $2,000 into 50. There is no problem there. It will be shown in investing. So this forex gain relating to cash equivalent, so that has to be shown separately below the cash flow statement as a reconciliation, so that we are able to reconcile balance as per the cash flow and the balance sheet. So we had seen this example earlier. So if it is direct method, it will come only in one place, that is, it will come in reconciliation. So here we will show plus forex gain. If it is indirect method, it will come in two places. First we need to adjust it. In that earlier example we had adjusted forex loss. So we have to minus forex gain here and add forex gain here. So that is how we will do for this question. That is the answer. Now the answer is given as per the indirect method. So exchange difference should be deducted. So on the top, adjustments, you deduct the gain and then again you add it. The exchange difference should be added to reconcile with the balance as per the balance sheet. Next, let's do test your knowledge question 4. So company A is acquiring 70% stake. It is gaining control. Cash consideration is 15 lakh and it is also issuing equity shares, which is not going to come in the cash flow statement. So part of the net assets of the company B which it has acquired includes cash and cash equivalent of 2 lakh 50. So how will we show in the cash flow statement? We will show under investing activities the consideration paid net of the cash and cash equivalents of the subsidiary recognized. So 15 lakh minus this 2 lakh 50 will be shown in investing activities. Further, it is acquiring 10% stake. Now this does not relate to gaining or losing control. So this is an equity transaction. So where will this come? This will come in financing. So the consideration paid net of the cash and cash equivalent balance of subsidiary recognized, that is 12 lakh 50 will be shown in investing, and then this additional purchase will be shown in financing. So another point is when we make adjustments for inventory or debtors, right, the portion of the net assets of the subsidiary that is acquired, that is already included in this net consideration paid, right. So in essence, the other net assets are also shown in investing. So when you prepare cash flow from operating activities, that effect should be considered. So we saw that earlier, the concept. So that is explained in test your knowledge question 5. So they have given consolidated P&L, and then if we come down, so these are the net assets acquired. They are acquired for 74,000 in cash. These are the net assets: inventory, trade receivables, cash, then property, plant, equipment, trade payables, long-term debt, goodwill. So the consideration paid 74,000 net of the cash or the subsidiary recognized 2, that is 72,000 will be shown where? It will be shown in investing. When we prepare cash flow statement, consolidated cash flow statement, so all these other net assets are also automatically recognized in investing. So plus 4 inventory, plus 8 trade receivable and so on have already come in investing. So if you look at the balances here, from 50 it has become 54. So this trade receivable plus 8 is also there in this 54, right. So 50 plus 8 minus 4 it is, this 54. So trade receivables have actually reduced by 4,000, and that reduction in trade receivables will be shown as a positive value in working capital changes. Essentially, we need to prepare this working. So, opening balance in this question, so 50,000 trade receivable, 35,000 inventory, and then 60,000 trade payable. Then what is it that we have acquired from the subsidiary? Those are given here: 4,000, 8,000 trade receivable, 32,000 trade payable. And then we write the closing balance. So, closing balance we write this 54, 30 and 68. So, the balancing figure will represent the change other than due to acquisition that will appear in working capital changes in the consolidated cash flow statement. So, in this video we have revised the theory of Ind AS 7. We have also gone through the concepts and the mechanics. We have also gone through the important illustrations of the study material. This should be more than enough to help you revise for the exam. Thank you and all the best.